Michael Burry sold all of his US holdings except for a single one, Estee Lauder. He loves situations where the stock has been hammered and he can bet on a turnaround. Estee Lauder has lost 80% of its market value from its peak in 2021 due to serious problems in the Chinese market. It started with a slower than expected economic recovery, but it worsened significantly when the government disrupted the Daigou business and the travel retail sector just collapsed.
All global premium and luxury brands suffered, but no other company struggled as much as Estee Lauder. Between its declining sales and growing costs, it just evaporated profits and cash flows.
Yes, and surprisingly, its market share had survived. It's still the number one makeup and skincare brand, and the turnaround strategies show the first signs of success as well.
Today, we are talking about a company that was once considered one of the biggest beneficiaries of the secular growth trend in fashion and beauty, and that is Estee Lauder. In 2021, it reached pretty incredible highs and was valued well north of $100 billion. And well, since then, the stock has seen one of the most severe downturns you could really imagine for a company of its caliber. Even deep value investor Michael Burry, who was made famous by the really great movie The Big Short, has jumped on the bandwagon and is long Estee Lauder. So for value investors like us, kind of sounds like the perfect time to take a closer look.
Absolutely, and that's why I bought the company today. We have a lot of Burry fans in our intrinsic value community. When they saw his position in Estee Lauder, we were asked to cover the company, so I thought, why not? I mean, I'm not an expert on the beauty industry, but the setup does look intriguing, and we already have one beauty company in our portfolio.
Right. One of our earliest additions to the intrinsic value portfolio was, of course, Ulta Beauty.
But besides the industry, the stocks do not have too much in common though. When you pitched Ulta, its stock chart didn't look even remotely as bad as Estee Lauder's, and it's still traded at lower multiples. That's because Estee Lauder is not one of those businesses that just became unloved by the market for no reason. The business has really struggled in recent years, so there's no doubt today's story is about a possible turnaround. And if that happens, the upside could be huge. And if it doesn't, well, then the question is, what is Estee Lauder actually worth at this point? So today, the focus is on two key aspects. The first would be figuring out how likely a turnaround is, then how much we could lose if a turnaround is not happening. Morningstar actually has a price target of about $120 for Estee Lauder. That's pretty much a double from today's prices. So the potential upside, if a turnaround would happen, is not really in question.
I guess Estee Lauder is one of those businesses where I don't think we have to explain a lot. Everybody probably knows it's a leading beauty retailer in the sort of premium segment. And the product categories overlap a lot with what we know from Ulta Beauty: skincare, makeup, fragrance, and hair care. And it's not just the Estee Lauder brand, but they have an umbrella of brands, right?
Right. Estee Lauder owns about 20 brands, and internally they are categorized into four different baskets. That's luxury brands, then large brands, scaling brands, and developing brands. And some of those brands can belong to multiple categories. So Tom Ford would be an example, which is a company that Estee Lauder acquired in 2023 for about $2.3 billion. And it falls under both the luxury category and also under the scaling brands. With these different categories, Estee Lauder wants to diversify its product portfolio to appeal to as many customer segments as possible. But as we know, premium brands must be careful to not dilute their brand by onboarding lower quality brands. And besides product diversification, Estee Lauder has also diversified through its global presence. So while Ulta Beauty is still primarily a US-based brand, in its early stages of expansion into other countries, Estee Lauder is already there, operating in 150 countries. What's alarming though is that its revenue in the Asian and European markets has dropped quite significantly in recent years. So while the Americas remained relatively flat from 2022 to 2024, Europe declined by about 20% and Asia by 10%. And when we look through the product categories, pretty much all of them are declining. But since skincare is by far the biggest segment, that's also where the decline is the most notable.
But despite that apparent diversification from what you already told me about the company, I guess we'll see today that Estee Lauder perhaps isn't as diversified as it seems after all. So while the sales numbers and especially the operating income numbers look very high in Europe, a lot of that actually comes from Chinese travelers spending in Europe, which actually significantly increases the overall exposure to China. But before we dive deeper into the business fundamentals and the investment case, as always, let's take a trip into the past and hear about Estee Lauder's business. I think the story is quite interesting.
It is, especially because this is the first time we cover a company founded by a woman. I was shocked when I looked through all the other pictures and saw that all of those were founded by men. I think only New Bank had one female co-founder.
Oh, I didn't realize that. It sounds like it's about time then.
It certainly is. And there are few better women to start with than Estee Lauder. She was one of the most influential women in American business history. And as it often is the case with either fashion or cosmetic brands, the company is named after its founder. So that's where the name Estee Lauder comes from. Although she was born as Josephine Esther Menzer in Queens, New York, as the daughter of Hungarian and Czech immigrants. And when you go through her life story, you quickly realize that she was pretty much destined to work in the beauty industry. Her uncle was a chemist who made creams and lotions, and as a young kid, Esther was just captivated by that. She began learning how to mix her own formulas, how to package them, and then eventually also how to sell them. And I think you could say that her biggest strength was actually that she was equally passionate about both beauty and business. She turned out to be a real marketing genius, and that was at a time when marketing was not as big of a topic as it is today. So we're talking about the 1920s and 1930s here. For example, she was one of the first to give away free samples at beauty counters back then. And that's a practice that's now adopted by nearly every store you walk into. And she was a huge advocate of word of mouth marketing as well. So her motto was telephone, telegraph, telewoman. And that motto is based on the power of word of mouth, but also on her belief that women care deeply about relationships and forming personal connections when making purchasing decisions. And I suppose that's true not only for women, but just generally for everyone. I mean, I'm definitely more likely to buy a product when a friend is recommending it.
I think that's why online sites like Amazon tried to replicate those word of mouth dynamics through the recommendation and rating features that you can see there. Those features are over 30 years old and are still crucial for these businesses. So today, this system not only helps customers make better informed decisions, but also provides Amazon with really valuable data to personalize its recommendations with. And over time, that has evolved into these algorithm-driven suggestions. Customers who bought this also bought sort of stuff, which became central to the e-commerce experience and helped drive both engagement and conversion. So that was a bit before Estee's time, though.
Yes, it was. But she used all of that as well, just in more of an analog world. You know, in the early 1940s, before she had her own shop, she even went from like store to store in New York to get her products onto the shelves of other retailers. And then the big break came in 1946 when she officially founded the Estee Lauder company with her husband, Joseph Lauder. And just 2 years later, they got their first major retail contract, by the way, with Saks Fifth Avenue. And that's the same company that has now partnered with Amazon, which we mentioned in the episode, to implement a luxury offering on its marketplace. And well, from there, the business really took off. It still took a pretty long time until the business was actually made public, because even after the business became successful and she, could have taken a backseat, Estee Lauder was still very hands-on involved, and she didn't want to either lose control or be forced to do anything because of short-term pressures of the market.
Most times someone starts a company, but they end up getting pushed out eventually because the traits that made them uniquely skilled to successfully launch a business become almost less useful over time, and it becomes more important to have someone who is an operational expert and maybe knows how to manage people really well. And another way to say that is that you want a bold, idiosyncratic visionary to lead things at the beginning and kickstart the momentum of the company. But at some point, predictability and stability become a lot more important. And that's what happened at Lululemon, for example. And even at Ulta, the founder wasn't the person who really made the business into what it is today. That was Mary Dillon, who took over in 2013 after the company had already been around for more than 20 years. So it's a special thing to have a founder who can persist as a great CEO or board member or whatever it is across the different stages of the business cycle, kind of guiding the company. A great founder, I think, can really define a brand for generations.
I think we had a similar discussion in our Shopify episode where the founder is still the CEO and he holds most of the power in the company. But the question is whether he can turn from, being that visionary also into an operator at some point. Airbnb, which is one of our portfolio companies, will face that question too at some point. Although I personally feel that Brian Chesky probably can do both. But both of these companies are still young. And in Estee Lauder's case, we're talking about a person that built this company for about half a century, similar to what Buffett or Bernard Arnault did. Even when the company went public in 1995, 50 years after its founding, and at a time when she was already in her 80s, she was still involved in the business. And I love to see that form of commitment. And I do believe that in most cases, not in all, but in most, this nurtures a special culture within a company.
It also reminds me of the story Buffett always loves to tell about Rose Blumkin. She was the founder of Nebraska Furniture Market, as I know you know, Daniel, and she was an immigrant just like Estee Lauder, and she built one of the largest furniture retailers in the US completely from the ground up, starting with, I think, like $500 in a basement. And Buffett was always amazed by how Rose Blumkin would work 7 days a week, well into her 90s, which I think Buffett has emulated. And she was just selling furniture with a laser focus on making sure the customer always came first, just like Estee Lauder. Both women built hugely successful businesses through sheer determination, hands-on work, and a real connection to their products and their customers, and just a lot of pride in what they were doing on a daily basis.
And both did so at a time when the business world was still dominated, and it still is dominated by men. But back then, very few women were in such positions, even less than today.
Definitely. But how about we jump to the more recent past now? Estee Lauder is one of those businesses that is often referred to as a high quality company, which is kind of this blanket term where you're like, okay, what does it actually mean? And for a very long time, though, I do think it fit that description pretty well. From 2005 to 2022, the company compounded earnings per share by 13% annually, with returns on capital in the mid-20s and an even higher ROIC, returns on incremental invested capital. So there was a time when Estee Lauder performed very well, and the market rewarded that with kind of this twin engine of, not just a rising stock price because of earnings growth, but also a higher multiple being paid for those earnings. But in recent years, Estee Lauder couldn't keep up with that performance. Premium and luxury fashion and cosmetics brands struggled in general, but Estee Lauder was hit particularly hard compared to its competitors. Why couldn't Estee Lauder keep up with the overall growth in the industry since the pandemic? Is the brand just no longer as popular? Did the management team make some sort of strategic missteps? Or I'll just ask you, Daniel, what is it? What caused this?
I'm afraid it's pretty much all of the above. I mean, the pandemic was obviously a huge hit for the business, and we all know how long China has kept lockdowns going and how slowly the economy has recovered afterwards. It's still somewhat in that process. But despite that, in 2021, Estee Lauder was one of the biggest beneficiaries of the stock market's exuberance, and the nightmare only really started in 2022, both for the company and also for the shareholders. And a major impact was a policy change in China. I mentioned how Estee Lauder is active in 150 countries. And when you look at the revenue by region, the business looks pretty well diversified. But as you have teased in the beginning, the reality is that a significant part of operating profits came from Chinese tourists buying beauty products in so-called duty-free shops in South Korea or Hainan and even overseas in Europe. But it's not just tourists using these duty-free shops. It has become a whole business model to use these shops for reselling products. And people who do that are called daigou. They buy prestige cosmetics, but also fashion brands in bulk in duty-free zones. And then they resell these goods at a markup, but still below retail prices in China's mainland. And before I researched this, I would have never thought that this practice could be so widespread, that beauty giants like Estee Lauder would essentially depend on it. I mean, if you briefly mentioned this last week in your LVMH episode, and Bernard Arnault once said about daigous, quote, "For your image, there is nothing worse. It's dreadful." And while that might be true, the business model itself fueled a lot of Estee Lauder's growth. And not only Estee Lauder's, it's not a coincidence that LVMH, Kering, and many other luxury brands, and also premium brands, are struggling right now. The Chinese Daigou market was once valued at around $81 billion dollars. And I say was because in 2023, China's government began to fight against this practice.
Okay. So do you know why China acted in 2023 to crack down on that practice? Was there something specific about that timing, especially since this has been a practice that had been going on for such a long time?
So the most obvious answer would be that the benefit of boosted consumption just no longer outweighed the fact that the gray market made the government miss out on billions in tax money. But there might be another reason as well. So while South Korea is the largest duty-free market in the world, the Chinese province of Hainan was becoming more and more important for this Daigou practice as well. And the backstory here is quite interesting. Since Hainan is a Chinese province, you might ask, well, why it's tax and duty-free anyway? Well, Hainan is an incredibly beautiful tropical island, perfect for tourism. And since China wanted to boost domestic tourism, it introduced a pilot policy in 2011 that allowed domestic tourists to purchase imported goods on the island without paying any import duties, VAT, or the luxury consumption tax that you would need to pay in China. And all of that basically just to kickstart tourism and encourage Chinese shoppers to spend at home rather than in Paris or Seoul. Every traveler was allowed to bring almost $14,000 back from these trips. And now, getting to your question, why crack down on it in 2023? So, besides the obvious reason that the gray market had simply become too big, Hainan had also become pretty popular and probably popular enough as a travel destination. So last year, duty-free sales fell almost 30% and shopper numbers declined by 16%. But despite that, the island visitors were up by 8%. So people didn't just go there anymore to buy products at a cheaper price. It has become a travel destination by now, which people visit just to go there for the weather and the beaches.
Was the Daigou crackdown the main driver for Estee Lauder's downfall? The European numbers declined pretty sharply as well, it seems. And even in the US, there's no growth. And while stagnation is better than declining revenue, as in some of those other regions, competitors did keep growing. And I kind of know that from having studied Ulta. So it seems like they're still losing market share, right? When we take Ulta, we just got their latest earnings report and the growth numbers were really solid, like I said. So they also sell Estee Lauder products, but judging by Estee Lauder's numbers, it seems that they're really not the best-selling products at Ulta.
Yeah, that's true. There are a lot more problems than just the Daigou practice. Although the decline in Europe and in part also the US also goes back to these Chinese customers who, travel there, bought expensive goods and then brought them back to the country. So less travel, and again, these stricter border controls slowed down luxury sales from Chinese tourists, and that's why Europe and the US also declined, at least by that much. And as you mentioned in the beginning, Estee Lauder wasn't remotely as diversified geographically as it's seen by just looking at the numbers. Morningstar actually estimates that as much as 93% of the entire sales decline has been caused by the Chinese market. Now, that might sound very bearish at first, but for me personally, that means that the brand itself is not in such a sharp decline, maybe even not at all. So spending in China has been down across the board. And if you add the Daigou situation to that, all the headwinds might have been a worst case scenario for Estee Lauder, but they can go through that and recover. So the downturn caused inventories to shoot up, and it came right after Estee Lauder's debt position had significantly increased in recent years. From 2016 to 2023, long-term debt had almost quadrupled. And that's driven by the acquisitions of Too Faced, Dr. Jart Plus, and also Tom Ford. And at the same time, while debt kept piling up, cash flows were flat over the same period. I think inventories also piled up, tying up working capital, putting pressure on margins, then ultimately just decreasing profits and cash flows.
There's really not a lot working out for Estee Lauder in recent years, it seems. The inventory trend is something that I've seen with LVMH too. Their inventories doubled in the last 4 years as well. And long-term debt also went from 5 billion euros in 2019 to 12 billion euros last year. And the difference with LVMH is that their cash flows have stayed pretty healthy, but they have more or less also stagnated in the last 3 years, which is significantly better than what Estee Lauder has gone through.
Yeah, the picture is very similar to all fashion and cosmetic companies with exposure to China especially. L'Oreal, for example, which is Estee Lauder's biggest competitor, shows the same trends, so rising inventories, and in 2022, they took on debt for the first time in the last decade. So it basically went from zero all the way to 5 billion euros, but their cash flows, just as LVMH's, kept growing. So that's the big difference here. Still, and honestly, that surprises me a little bit, when we look at the market share data, Estee Lauder remains the global market leader in prestige skincare and also in makeup, not just in Europe. It's actually in the US and also in China, despite their declines. And between 2021 and 2024, the company lost only about half a percentage in these segments in China, which is impressive given by how much Estee Lauder underperformed competitors in that country. And the trend looks promising as well. Estee Lauder recently gained market share across all categories in mainland China and became the #1 fragrance company in Japan in 2024, thanks to brands like Le Labo and John Malone London. And as we discussed when talking about our own beauty shopping habits, these products tend to be quite sticky. Although even that seems to change more and more. I've just recently read a McKinsey study which said that actually about 40% of consumers in the US, Europe, and China regularly try new products and brands. A significant factor in that change has, of course, become e-commerce and social media. You just come across so many more different brands and products, and it only takes a couple of clicks and then a couple of hours before you actually get them. If you enjoyed this show, I would bet that you would love our Intrinsic Value community. It's a private network for sophisticated long-term investors who care about deep research, sharing actionable investment ideas, and making meaningful connections with like-minded individuals. Besides reading all the value investing books I could get my hands on and doing my own valuation work, nothing helped me more than getting feedback from a group of sophisticated investors with diverse backgrounds and distinct circles of competencies. We also host calls with a variety of experts and investing professionals who share their unique strategies and insights with our members. But we are only opening up 30 spots for a limited time. They will probably fill up fast, so if you want to invest better and surround yourself with people who do the same, you should join our waitlist for the Intrinsic Value community at theinvestorspodcast.com/intrinsic value community. That's theinvestorspodcast.com/intrinsic value community.
Hey guys, this is your host of the Intrinsic Value Podcast, Shawn O'Malley. Just like everybody else, there was a time when I was a beginner investor, and I have to say, investing is particularly filled with jargon that can just make it so difficult for new investors to understand what is going on. But it's never too late to get smarter about stock investing from the ground up. At the Investors Podcast Network, we've made a habit of studying the world's best investors, and now I'm distilling those learnings into a simple course for you, or for anyone in your life who you might want to share the gift of knowledge with. With my How to Get Started with Stocks course, you can master the principles of excellent lifelong investing with valuable insights for both beginners and pros. The course covers 10 different sections, beginning with the basics of what a stock actually is and how the stock markets work, to strategies to optimize your retirement savings, how to pick great companies for the long term, what to look for in ETFs, and how to monitor your investments, plus so much more. To begin getting smarter about investing, just visit theinvestorspodcast.com/get started with stocks. That's theinvestorspodcast.com/get started with stocks. And for a limited time, you can use code STOCKS15 for a 15% discount at checkout. What if every home had a freeze dryer? Sounds crazy? Maybe, but once you see what a Harvest Right freeze dryer can do, I think you'll be wondering how you ever lived without one. With a Harvest Right freeze dryer, you can preserve what you love to eat, from fruits and vegetables to full meals. You can keep your favorite healthy foods fresh for years. No more highly processed foods loaded with preservatives. As a value investor, what I love most about Harvest Right is that it helped me to stop throwing away leftovers or having to watch my fruits and vegetables spoil before I could eat them all. Freeze drying can be both healthy and fun, of course. You can make nutritious snacks like freeze-dried fruit, or fun snacks like freeze-dried ice cream and candy that your whole family will love. My Labrador Retriever, Riley, certainly loves her freeze-dried treats. So go ahead and stock your pantry with real, wholesome food that's always ready when you need it, no matter what is going on in the world. Learn more by visiting harvestright.com/investors. That's harvestright.com/investors. It's similar to what we can observe in fashion with the fast fashion movement, right? An advantage for premium or luxury brands like Moncler and LVMH, which we covered before, is that luxury labels have a lot more weight in fashion than in cosmetics. And private labels have become increasingly common in the mass beauty market. And for anyone who doesn't know the concept there, private labels are just products sold by well-known retailers under their own branding, but they can be made by third-party manufacturers on their behalf. So Ulta Beauty and really most cosmetic retailers have some sort of private label line that they've established by now, and they tend to sell pretty well. The quality of these products in many cases has become a lot better than it used to be. And from what I have read, it's hard to tell the difference, not only in the mirror, but also in the performance and just maybe the feeling of the makeup or skincare products.
In contrast to those luxury fashion brands that you mentioned, it is not immediately visible, if at all, whether the makeup someone wears is from Estée Lauder or a cheaper brand, and perhaps even a private label product. So premium companies like Estée Lauder must find a way to differentiate their products and imply they have higher quality. But that gets increasingly more difficult. Younger customers tend to prioritize functionality over brand prestige when it comes to cosmetics. And usually I'm a skeptic about these trends just because it's normal to spend less money on brands when you're younger. In your 30s, 40s, and even 50s, you might enjoy buying premium brands. But as you said, in cosmetics, you don't really see the difference anyway. And every brand with a certain quality standard portrays itself as, being ESG friendly and dermatologist proven, which is what consumers nowadays care about. So that's not a unique selling point for any premium brand anymore. In fact, when you look at Estee Lauder's R&D spend and you compare it to their marketing spend, you will realize that R&D is only a small portion of it. Most money goes into marketing. That spend is actually 10 times higher than R&D. I guess there's only so much you can do on the quality side, and all the big brands have the capacity to spend money on that. And there's another trend that hurts the company, the upcoming of social media, of course, but also personal brands. You mentioned that in your Ulta Beauty pitch as well, right?
Yeah, I did. I compared Ulta's following to Sephora since I kind of saw them as the main competitor. And for these brands, social media has become incredibly important, of course. If there's a trend on social media, especially TikTok, that can really quickly turn into a multi-million-dollar opportunity for Ulta, Sephora, or Estee Lauder. But premium brands like Sephora or Estee Lauder have a harder time being part of these trends where people go around and show off their fashion hauls, for example. That mostly happens with cheaper brands or where you can get special offers. Ulta offers a lot of these through its loyalty program, and Sephora just doesn't offer those kind of discounts. And I don't really think Estee Lauder does either. So that makes it a lot harder to go, oh, look how much stuff I got for $100. It doesn't really translate at a more premium retailer.
It's more difficult, and usually Estee Lauder doesn't do that. But there have been exceptions in the Chinese market, but we'll get to that at a later point. Let's quickly talk about personalized brands and how they changed the industry. Back in the day, celebrities modeled or advertised for brands like Estee Lauder, and of course they still do that, but you will see a lot more individual brands, and those have become real competitors. They're just huge companies. To just list a few, you have Fenty Beauty by Rihanna, Kylie Jenner Cosmetics, Rare Beauty by Selena Gomez, and Hailey Bieber has her own line as well. And I could go on for a while here. And these are really big companies. Fenty Beauty is valued at $2.8 billion, which is more than Estee Lauder's most expensive acquisition ever, and that was Tom Ford, for which they paid $2.3 billion. Kylie Cosmetics is valued at $1.2 billion, and Hailey Bieber's company was just recently sold to Elf Beauty for $1 billion. So it's not just value on paper. Those companies actually sell at those valuations. For a company like Estee Lauder, this is both competition and opportunity. It's still an acquirer, although Tom Ford was its last deal in a while, and currently I would be more than surprised if we see any new deal announced anytime soon. And even when the company would be doing much better than it is today, the dramatically lower barriers to entry are not helping Estee Lauder and any incumbent for that matter.
You just teased that Estee Lauder is handling discounts in China a bit differently. So let me take the opportunity to ask you about their strategy more generally in China and in Asia. Estee Lauder is the beauty company that probably bet heaviest on the Chinese market, is my understanding. And honestly, before 2022, the stock market and really the entire industry had applauded Estee for that foresight. Every brand wanted to be in China, and Estee Lauder was really leading the way over there, I would say. And the stock price skyrocketed to $370, resulting in that market capitalization of around $130 billion that make it a close second competitor to L'Oreal, or at least a lot closer than today, where L'Oreal is worth something like 8 times as much as Estee Lauder. The Chinese economy recovered much slower than anticipated during and after the pandemic, and then they had that subsequent real estate crisis. And you add to that the Daigou breakdown and the Asia strategy, which the market loved in 2021. Now it was seen as this risk, and the company was overly concentrated on betting on that part of the world. But beyond the macro headwinds, how does it look over there for Estee Lauder now? Is it a similar dynamic compared to the Western cosmetics market?
China definitely faced some severe headwinds in recent years, but it looks like the economy is heading into the right direction now. And the same applies to the Chinese beauty market as well. And in China, there's still this trend to go for more premium brands, and you consume more of those than we do in the Western world. The middle class is still growing, and people who enter it want to display that they've made it. And even when that's easier to do with luxury fashion than cosmetics, it still feels good to know that you're wearing expensive makeup. But that doesn't mean it's an easy market for Estee Lauder. The days when a European or an American brand had some form of a special appeal to Chinese consumers is largely over. I've seen that shift when I researched for my Mercedes episode. And in cosmetics, there's actually a name for that shift, and it's called Sea Beauty. Sea Beauty is about homegrown Chinese beauty brands that focus on Chinese heritage and designs, and those brands have become extremely popular over the last 5 to 10 years, especially among younger consumers. These companies have leveraged digital marketing, competitive pricing, and even a form of patriotic appeal to capture market share within those customer segments.
It makes sense that in cosmetics, rather than fashion, for example, local brands should probably have a bigger appeal than foreign ones. While style also varies, skin tone, climate, and just other cultural ideas of beauty can play a significantly larger role in cosmetics than in fashion, I think. So it's only natural that local brands can sometimes serve those markets better. A Chinese brand, for example, might formulate products specifically for humid subtropical climates or for common skin concerns in those areas. And they also tend to be faster at picking up on local trends, such as the current wave of traditional Chinese medicine inspired skincare, or the packaging aesthetics that resonate more with younger Gen Z buyers in China. Western legacy brands, on the other hand, often roll out these global campaigns with slower product cycles, which don't always match the speed or nuance of local consumer behavior. So, do you know how Estee Lauder has approached that challenge? Do they own local brands in their portfolio, or do they just create local campaigns within their existing brands?
Estee Lauder does own Asian brands. It bought a Seoul-based company, Dr. Judd Plus, which I already mentioned, which was a major move at the time, not just because it gave them a foothold in Korea, but because it was the first time that Estee Lauder fully acquired a company headquartered in Asia. And Dr. Judd Plus was not just any niche label, it was one of the most successful examples of derm science skincare. So that means minimalist design, clinical positioning, very popular among younger consumers who care less about those luxury logos and more about the ingredients in the product, and also about results. And that's an audience that Estee Lauder needs to target a lot more. And by the way, when I did my research, I stumbled up on Reddit again.
Oh, you did? Okay. It's one of those rare occasions that Daniel's on Reddit.
Well, as I said, when I need an insight into how people perceive a product that I personally don't use, it's a great place to start. And there were quite a lot of people who liked the products a lot. The Dr. Judd Plus deal was meant to do two things: tap into fast growing regional trends and also diversify the company's innovation pipeline. Korean beauty, and especially the kind driven by dermatologists and science-backed formulas, has become very popular in recent years, and not only in China, but also in the US and Europe. And that's what I listened to and heard on Reddit, for example. But the brand performed poorly since Estee Lauder's acquisition, and they actually had to book impairment charges of around $800 million. So it's hard to say whether that's mostly because of the macro headwinds or because they just failed to deliver new hit products. Many competitors bought Korean brands at the same time and they faced similar issues. Beyond Dr. Jart Plus and some smaller investments, the vast majority of Estee Lauder brands are still American. So the main idea remains to sell products of those brands in China. To increase the local fit, they've built a big R&D center in Shanghai though. The goal is to, develop products specifically tailored to Asian skin types, climates, and just their consumer preferences. They also test reactions to pollution and humidity, problems which are pretty common in big Chinese cities. And Estee Lauder has also made minority investments in Forest Essentials, which is an Indian premium skincare brand that combines local skincare knowledge and tradition with luxury positioning. It's a relatively small investment, and I just mention it because it shows they've been scouting. They've scouted different regions for emerging consumer movements, and they really plan on expanding into more emerging and fast-growing markets, which is a focus now. They want to prioritize that, and those could be markets like India, Brazil, the Philippines, and also Mexico, which I think is where Ulta Beauty is now going into. And all of those countries are labeled priority emerging markets. In many of those markets, only half of Estee Lauder's brand portfolio is available yet, and they want to bring it to more countries and just expand it.
So they've gone way beyond just trying to establish European or American brands in Asia. Did they also change the shopping experience? I think in Asia, selling over social media, especially in live streams, is a much bigger thing than in the Western world, right? And in cosmetics, probably even more so than with other products. I know that in some parts of Asia, e-commerce adoption is actually ahead of the US, like in South Korea, for example, which is something that really surprised me when I dug into Coupang for an episode a few months ago.
Yes, and the size of these sales channels is just mind-blowing. I actually couldn't believe it when I first heard it. China's live streaming e-commerce market, for example, is projected to reach over 8 trillion yuan by 2026, and that is over 1 trillion US dollars, and that's about the size of the entire US e-commerce market. Of course, Estee Lauder cannot miss such an opportunity and is also integrated into these and also other sales channels. It basically operates so-called flagship stores on platforms such as Tmall, which is owned by Alibaba, and Douyin, which is what TikTok is called in China. And they've built this full digital commerce ecosystem with influencer live streaming, real-time social selling, and all of that tailored to the Chinese market. And the majority of the ad spend in China now goes into digital and influencer channels and not anymore to, let's say, actors or TV advertisement. But competition is really tough. You probably know the Singles Day, which is a huge mid-year sale in China, and it's kind of like the Black Friday here and in the US. And those days have become a major driver of beauty sales, with brands offering steep discounts and also special sets. Estee Lauder also aggressively participated in these events to drive volume, but as listeners of our show, of course, know, premium brands like Estee Lauder lose their appeal when they engage in these discounting games. And in the short term, it might boost profits, but in the long run, it just kills the brand.
So to summarize the Asia strategy in business, Estee Lauder seemed to think that China is the place to be, double down on that market, and kind of neglected diversifying into other markets, and then paid the price for that when Chinese demand weakened due to the pandemic, the slower than expected economic recovery, and then the crackdown on Daigou resellers. And inventory piled up, margins collapsed, and what was seen once as this brilliant Asia strategy now turned into this huge problem for the company in its stock. So do I understand that correctly? And if so, is a bet on Estee Lauder really essentially a bet on the recovery of the Chinese consumer then?
That's definitely a big part of it. And the Chinese economy will rebound, and I think we're getting closer to that point. The main question, though, is whether Estee Lauder can benefit from that as much as some investors think. And that question extends beyond just China gaining traction again. So, a stronger Chinese consumer will certainly help, but it will not immediately result in a thriving company. The main reason for the terrible performance has been the negative operating leverage in recent years, and that's why Estee Lauder has been punished so much more by the market than its peers like L'Oreal or LVMH, at least to some extent. Revenues declined by more than 15% since the 2022 highs, and in the same period, net income just went from almost $3 billion to negative 870 million. The reason for that is that costs just continue to grow while revenues decline. The company should have brought fixed costs and marketing expenses down, but instead of doing that, they just kept going. And this was made worse by asset write-downs of about $1 billion, largely due to Dr. Judd Plus, which I discussed earlier, as well as Tom Ford and Too Faced, which is a brand Estee Lauder acquired in 2016. On top of that, Estee Lauder also incurred costs of nearly $500 million for restructuring and $160 million due to a settled lawsuit.
What was that lawsuit about?
Apparently, some talc-based products contained asbestos, which caused diseases for some customers. Estee Lauder, of course, responded that they only use tested talc, but the court denied the motion to dismiss, so the parties settled and Estee Lauder had to pay. And that's not the only lawsuit Estee Lauder had to deal with, because just 2 months ago, a judge actually decided that it must also face a lawsuit because of defrauding shareholders just by massively understating the overexposure to China and especially their gray markets, aka Daigous.
Well, there's certainly a lot going on at Estee Lauder. You might also remember how we talked about Bernard Arnault's family in our LVMH episode last week. We compared it to the show Succession, which is one of my favorites on HBO. But from what I've heard, that comparison might actually be even more appropriate in this case with the Estee Lauder family.
Yeah, there was quite a lot going on. So if that's your favorite show, you might as well want to read more about, the Estee Lauder family. And it's actually not just interesting gossip. It's also important for the company since the fight for power within the company has led to multiple management changes and also a new CEO. So what's important to understand is that while Estee Lauder passed away in 2004 at the proud age of 95, the company stayed in the hands of the Lauder family. It's still owning about 85% of the voting shares, so you might add that to the list of risks if you do not trust them. And over the last years, the unity between the family members has significantly suffered. Most of the public face of the family has been William Lauder, who is Estee's grandson, and he served as executive chairman since 2009. The CEO, though, was Fabrizio Freda, who's an outsider and a former Procter & Gamble executive who had been running the company since 2009 and was rightly credited with professionalizing operations and driving global expansion, including the push into China. But over time, it seemed the trust between the family and the executive team began to crack, especially after the disaster with the travel retail, which exposed the overexposure to China generally and caused just a series of financial problems that followed.
So it was the family pushing back against the current CEO from the inside.
Yes and no. Parts of the family pushed back, but some others stood behind him. So there was just growing internal tension with some Lauder family members pushing for more control and a strategic shift. And the real turning point, though, came in April 2024 when it was announced that Jane Hertz-McHughes, a longtime executive who had been with the company since 1987 and was considered a potential future CEO, would be leaving. And that caught a lot of insiders and family members off guard. And shortly after that, the company announced that Fabrizio Freda would step down as CEO. He remains as a strategic advisor, but it was pretty obvious that the internal fight for power had been decided and it was time for a new management team. Stéphane de la Faverie came in as the new CEO. He's a French executive with long experience at Estée Lauder, including leading the Estée Lauder brand itself. He's not a family member, but he was seen as someone who understands both the culture and the business aspects. The problem was that Jane Lauder, the granddaughter of Estee and executive VP at the company, didn't like that at all. She thought she should have gotten the CEO role instead. And she was so mad for being overlooked that she actually wrote a letter to the board demanding that her cousin, William Lauder, the executive chairman, should be removed from that role. And the feud then escalated when Jane resigned later that year, and the board confirmed Stéphane de la Ferrière would become CEO in January 2025, and William would also step aside as executive chair. This marked the first time in almost 80 years that no Lauder family member held any operational title at the company, so it really is historical, and obviously all of that drama added a lot of pressure to the stock.
It feels like Estee Lauder, the company, not the person, went through everything that Bernard Arnault will be trying to prevent from happening at LVMH when his succession inevitably comes to fruition. But after all this drama with the new CEO, what is the strategic shift that you've alluded to?
There are two programs in place that are supposed to put Estee Lauder back on track. One is called the Profit Recovery and Growth Plan, and the other is their new Beauty Reimagined strategy, which started in early 2025. And the former was launched in late 2023 and was supposed to be only a 2-year initiative aimed at improving operational efficiency, cutting costs, and ultimately restoring operational leverage. The company expected some modest savings to help margins get back on track, but as revenue continued to decline, they expanded the plan significantly, and now the restructuring charges are projected to land between $1.2 and $1.6 billion, with up to 7,000 jobs eliminated globally. According to Estee Lauder, this will result in annual gross savings of between $1.1 billion and $1.4 billion.
When I look at the financials, I can only see a real spike in restructuring charges in the last year. And as you said before, that's about $500 million. So we can expect another $600 to $900 million in these restructuring costs in the next couple quarters. Is that right?
In the next quarters and years, right? The new plan is to complete the restructuring up until 2027. So it's not only about waiting for the cost savings to show up in the financials. That's why they have this Beauty Reimagined initiative, which is also supposed to initiate growth in the meantime. The first pillar is consumer coverage. They want to meet the customer wherever they are, and that means expanding into faster growing channels like TikTok Shop or launching premium brands directly on Amazon, in the US at least. And they're also rolling out freestanding stores for luxury fragrances in key markets, which is a smart move because fragrance has been one of the few bright spots for them in the last years.
That slogan and the idea to sell on Amazon now seems a little too familiar to me.
Yes, it's the same playbook Nike uses after its strategy shift away from DTC. That's not the only parallel. Just like Nike, Estee Lauder wants to get back to its innovative nature, and that's less about coming up with a new lipstick and more about speeding up development cycles and tailoring products for regional needs.
We have a solid and iconic brand in the portfolio of the Estee Lauder company. You've mentioned some of them, from La Mer to Estee Lauder to Tom Ford, Jo Malone London here, in the UK. And we are very convinced that our brands are really meeting the consumer demand around the world. We just need to be more agile. Right. We need to be faster, reacting, to the trend of, the consumers. And one of the things that I've committed is to make sure that we follow the consumers where they are going. Right. We need to be more reactive to where the consumer goes. And we need to simply just make sure that we give them the innovation that they are looking for in the time that they want it.
And it also had a huge inventory problem, just like Nike, which caused the same problems with working capital and the need for discounting products.
So the plan is to restructure and then reinvest and reposition the product portfolio.
Yeah, that's a pretty good way to frame it. But there are two other important levers, and that's geographic diversification and supply chain resilience. They've realized that the overdependency on China has to be addressed, so they're pushing harder into Southeast Asia, India, and Latin America. And on the operational side, they're trying to cut China's reliance on US sourcing from 25% to 10% mid-year, using facilities in Europe, and across Asia to buffer against tariffs and geopolitical risk. And yes, unfortunately, all of that is still a topic. After a couple of months, we are already discussing it. And then late last year, they also decided to cut the dividend after consistent dividend growth since the IPO in 1995, except for 2020 and the COVID pandemic. That's never a popular move, and we have discussed how the same thing could also happen at Nike down the road. And if that should happen, that's probably a bad thing. But in Estee Lauder's case, I see it as the right decision because it makes no sense to pay a dividend when your business is clearly struggling with profitability. And I would rather just see a plan laid out for a recovery, which they have done, than investing money there. And that's what they're doing right now. So I think that's the right approach.
Have investors seen any improvements yet?
There have been first signs of improvement, and it's obviously not yet the turnaround the company needs, but it looks like it could get there. In fiscal 2025, the company achieved over 300 basis points of gross margin expansion during the first 3 quarters, despite lower sales volume. And this expansion has largely been due to improved operational efficiency, leaner inventories, which they have finally brought down, and a reduction in discounts and promotions as a result of that. That's essentially what we both are hoping that Nike will report soon as well. On the growth side, Estee Lauder is seeing traction across several fronts as well. Its digital transformation efforts have definitely paid off, with digital channels now accounting for about 28% of total sales, and that's up from just 13% in 2018. So the company has also made some investments into AI, and while I'm not yet sure whether that will actually move the needle and be a significant cost saver, or was just, mentioned in the reports to be able to put AI in there, we should be happy about it because the partnership is with our portfolio company, Adobe. And the idea is to integrate generative AI into its marketing campaigns, also saving a couple dollars.
I saw a really great chart from Michael Mauboussin the other day, basically showing how hard it is for turnaround stories to actually come to fruition. And basically what they did is they broke out companies' returns on capital over 30 years, comparing the results from the beginning and then the end of the period. And they categorized the companies into these performance quintiles. So the highest returning companies in one quintile and the lowest returning companies in the bottom quintile. And they mapped out what percentage of companies would stay in their quintile over the time period, what percentage moved up and became more profitable relative to the rest of the group, and then what percentage became less profitable and moved into the lower quintile or just stayed flat. And to kind of make a long story short, the idea was that literally it's far more often that high returning companies just continue earning excess high returns than it is that lower quintile companies move up in relative profitabilities. So the winners keep winning most of the time, and it's less likely that a loser becomes a winner, even if they were a winner in the not so distant past. And so, for example, from 1990 to 2022, 48% of the companies that ranked in the top quintile of returns stayed in the top quintile. And then another 19% only fell a little bit to the second best quintile. Yet only 12% of companies in the lowest quintile at the beginning ended in the top quintile. And then just 8% of companies went from the second worst quintile and moved up to the top group. And that'll all make a little more sense if you're watching this on Spotify or YouTube. You can see the chart that we're referencing. But a really high level, the point is that statistically speaking, the odds are stacked against us here with Estee Lauder, where you have a company trying to go from now being in a lower quintile and moving back up as part of a turnaround story. But at the same time, that is how big payoffs can be earned. If most companies fail to turn around their businesses, and the market knows that, and yet you can identify one of the few companies that will actually do so, well, the payoff would be substantial. And so with that backdrop, how about we go to the part that people are really interested in, and that is your valuation. What exactly needs to happen so that you would be interested in Estee Lauder? And at what point, if ever, should we buy the turnaround story? Knowing that, again, the odds of Estee Lauder returning to a top quintile of profitability are not necessarily in our favor.
What's interesting about this paper has been that it showed statistically, you're definitely taking a risk with every turnaround that you take. And at the same time, the payout really can be big if you hit the right turning point, and that basically means you pay a low price. So when I valued Estee Lauder, I first wanted to figure out what it would mean for the stock if and when management achieves the restructuring that it is currently in the process of, and then recovers margins to approximately a 10% net income margin. That's what Estee Lauder earned for years prior to the pandemic era. So my base case is a more or less successful turnaround. And I say a more or less because it would take Estee Lauder 3 more years to return to 2024 sales. But due to the restructuring, profits should recover much faster than that. We already know that Estee Lauder won't return to growth this year, but next year we should see sales growth again, and even if it's just 1 or 2%. For the PE, I assumed a 2029 exit multiple of 22. That's far below the long-term average of 29 and even further below the average of the last 5 years, which has been above 30. But honestly, when I look at this company, I really don't find much that would still justify a premium multiple. We talk about the term quality, and you mentioned it earlier in this episode, and Estee Lauder is portrayed as this high-quality company currently under pressure and possibly trading at a discount, and its market share and pricing power do make it a better than average company. But if the last years have shown us one thing, then it's that this company is not bulletproof, and it's definitely not the last man standing in a bad macro environment. And for me, that's what I require from a high quality company that would deserve a premium multiple. It would take too long to go through the growth and profit assumptions for each segment, but essentially, I assume a return to the lower end of growth and profitability prior to the downturn.
Looking at your model, this gives you what looks like a relatively slow revenue growth estimate, but earnings would still compound at over 30% during that modeling period as they trim costs and begin to benefit from some of the operating leverage available to them as growth resumes. And of course, we have to keep in mind that this is going off a very low base. So 30% sounds huge, but really isn't that much compared to what Estee Lauder had earned in 2022, which was a particularly good year. And if I see that correctly in your model, you also have an adjusted earnings line in which you account for these impairments and restructuring charges. And when you do that, the EPS growth immediately gets cut in half.
All right. So this is definitely not a growth company, even though 30% might sound like it. Some of the growth numbers just look high because they were close to nothing at the start of the period. The next step is applying a discount rate. I use 8%. There's a lot of uncertainty involved in Estee Lauder's situation, but when we look at their market share data and the overall quality of earnings, I think the conservatism should be in growth and margin assumptions and not embedded in a higher discount rate. Long story short, I get a fair value of about $64 then, and this time I apply a 10% margin of safety as well, which is something that I'm usually not a huge fan of doing, but we could buy into a falling knife here, and when that's the case, we have to be extra careful about the price we pay. So this then leaves us with about $57. That's far below the current price of $75. And to be honest, I'm a bit surprised by that after seeing Burry go all in, at least in his US portfolio, and seeing the stock chart, a lot of people talking about it. I would have thought it was cheaper than that.
I agree, but as always, it highly depends on your inputs, right? So did you do a bull and bear scenario as well? Because I could imagine with a turnaround story like this, there's a pretty wide spread between the possible and plausible outcomes for a company like this.
I did, and you're completely right. The difference is huge. In my bull case, I achieve a net income margin of approximately 11.5% and revenue growth of still just 3.5%. With a bit of a macro tailwind, this is definitely probable and not even that bullish. And if you combine that with an exit multiple of 27, which is also in line with historical averages, you get to a fair value of almost $110, so significantly more. In the bear case, I assume the turnaround won't happen and Estee Lauder will kind of stagnate, not necessarily shrinking, but not growing either. And unsurprisingly, the stock has a long way of losses ahead of it then. Its fair value would be something close to $30.
The hard thing about investing is that I can imagine really why each of those scenarios could unfold. And while it's a good exercise to do some modeling and think through these possibilities, ultimately, it always comes back to your conviction in the brand. Do you feel good about the culture, the management team, their incentives, the durability of the products, the resilience of their supply chain, like those kind of things? And unless you have a lot of conviction in the value of their products or in the management team being able to lead a turnaround, like with Nike, when you have this great CEO coming back to kind of helm the ship, it's just really hard to say, okay, I think the bull outcome is specifically more likely to occur than the bear outcome or vice versa. Because otherwise, if you're just equally weighting the bull and bear outcome, you might as well just look at the base case because they're probably going to average each other out. And like I said, the Nike situation has been similar. And I think what mattered to you and me and what ultimately tipped the scales for us is that we are, or in my case, were customers and understand the product much more intuitively. And then additionally, there are these kind of more tangible advantages that Nike has over its competitors. So I don't know, I just have a better feel for what Nike could do to reinvigorate its business. And that is really what investment decisions can come down to, kind of a gut feeling. You can crunch the numbers all you want, but to some extent, there's a degree of pattern recognition that drives your confidence in making a final decision. Otherwise, if you just can't get there, it just goes on the too hard pile. And I don't really see the same advantages in Estee Lauder's case relative to Nike. And my impression is that you don't see those either, right? For better or worse, and due to your own personal biases and experiences, we just have more confidence in Nike's ability to beat the odds and successfully do a turnaround. And I keep bringing up Nike because that is really the only company in our portfolio that's a true turnaround. To a lesser extent, you could say the same about Ulta. But it was the same with LVMH last week as with Estee Lauder. I couldn't get myself to buy the stock just because the PE ratio looked historically low. Because if their sales seem very fickle and vulnerable to me, that low PE ratio is going to be illusory in the long run.
There's not much that I can add to that. And by the way, the PE is not even that low. As you said, it's similar to the Nike situation where the forward PE is still quite high because people do believe in a turnaround. And if other people believe in it and they're already paying the price for it, that's probably not the situation you want to be in. And despite reading as many reviews as I could, it's just harder to understand the market and its trends if you lack a personal connection to the product. And as you said, I don't see many equivalents for Nike's strength when I look at Estee Lauder, and that might be because I don't understand the company as well, but I just don't see it. And having said that, numbers don't lie, and the market share data still looks favorable for Estee Lauder. Their pricing power is also evident in the margins and especially in the past, but we're already seeing that kind of gaining traction again. At least under normal circumstances, this is a good company. And I can also imagine that the turnaround strategies will be successful. They seem very logical and the first signs of success are already showing. So for me, it's about the price I have to pay. And there's a great quote that fits here pretty well, I think. The definition of a stock that's down 90% is a stock that fell by 80% and then halved. I like to keep that in mind with turnaround plays. The chart looks very intriguing, but just because the stock has already fallen by a lot doesn't mean it can't keep falling further. And my base case might be a bit too conservative in the event of a turnaround, but I still assume a successful turnaround, and that's not even a given. And if even under these assumptions of a turnaround, the really attractive price is only in the 50s and perhaps the low 60s, then I wouldn't feel too good betting my money on it when the stock trades in the mid 70s. And as you know best, there's a reason why we even have Nike as just a 2% position in our portfolio. It is a turnaround play that takes time and it might get even uglier on the way. And by the way, when you guys hear this, Nike has just reported earnings, so you're much smarter than Shawn and I because we don't know those numbers yet. And I think this quarter could very well be a tough one again. And for Estee Lauder, the same is true.
Yeah, and to anyone who's listening to this and thinking, okay, how can you have conviction in Ulta but not LVMH or Estee Lauder? Well, the differences are subtle, but for one, Ulta is a diversified retailer. They sell prestige products like Estee Lauder, and they also sell mass market products like e.l.f., and then they sell private label stuff too that we talked about earlier. And they sell hundreds of brands. And really, they are more representative of beauty spending generally than they are tied to the performance of any specific brand. It's a much more resilient business model. And it's also domestically focused for the most part, which just makes the story a lot simpler for better or worse. And their business has not fallen off by nearly as much. I mean, it's really just stagnated as opposed to really getting a beating like Estee Lauder has. It's been pressured, but Ulta's ability to endure the obstacles thrown at it, I think, is a testament to their more diversified business model. And there's a great deal of functional utility to Ulta's products that are offered at fair prices compared to LVMH. And so I know that Ulta will likely continue to be the go-to retailer for a wide range of products, regardless of which brands are doing well or not, because they pretty much sell all of them. And Estee Lauder, and to a lesser extent LVMH, are bets not only on specific brands working, but also on the persistence of their premium pricing, which I just have much less confidence in. And in other words, I know a range of customers will continue to visit Ulta stores for their beauty needs because it has the best assortment of products and a really great loyalty programs. But I have much less conviction in specifically whether Estee Lauder's brand will do well. And that, to me, is the difference in a nutshell, which is to say, if you recommend it, Daniel, I'm more than happy to pass on this company for now, while maybe keeping an eye out for if the stock does get cut in half again and the bulls who are kind of still optimistically betting on the turnaround story here finally lose their patience, assuming nothing has gone catastrophically wrong, then I could see this stock being really, really interesting.
I totally agree. And to be honest, I still think that probability-wise, a turnaround is more likely than not. But we've just seen the statistical facts and how unlikely it is in most cases. I'm just not willing to bet on it at this point. It's also been the entire research process. It's been surprising to me how few people I could find that actually like Estee Lauder's product and would say they would never buy something else. I've seen that more often with Ulta, which is supposed to be a lower quality brand or retailer, but I don't really see feedback backing up those market share numbers. And that's a little odd to me. So I'm just not confident and I'm not feeling good about adding Estee Lauder at these prices. So I think it's safe to say we don't follow Michael Burry into this investment. And honestly, who knows whether he is even still invested at this point. I mean, he's not really known for holding his positions for a long time. So he might even have sold out a long time ago. All right, and with that, how about you give us your hints for the next episode? You know, the train keeps moving.
Keeps moving. Yeah, so next week will be a fun one. We're digging into a very unloved name. I'll try to give out some hints that don't totally spoil things, but that is easier said than done. This is a company that was one of the biggest COVID-era beneficiaries that the market has since fallen out of love with. Yet they dominate their market share in what is, I think, objectively a very promising and fast-growing area. And as a third hint, and I'm maybe giving away too much here, but if you don't know it after the other two hints, I'll say that if you live in North America at least, there's a very good chance you have one of these products physically in your home, or at least have had one at some point in your home.
One extra hint from me. If you are living in Germany, you definitely never had one of those products in your home.
Right.
All right. Today I will leave you with a quote from Peter Lynch, a short one for that matter. It goes, quote, "Turnarounds seldom turn." And I think that's pretty fitting for today's episode. And I won't go as far as saying Estee Lauder won't turn. I'm just not yet ready to bet my money on it, perhaps at some later point. And with that, have a great day and see you next Sunday.
Ulta has proven to be one of the few retailers that are relatively resistant to the Amazon effect, but the stickiness of its in-person experience with the next generation of customers will be key to its ongoing success. Brick-and-mortar stores have an inherently higher cost structure than Amazon, leaving Amazon with more capacity to sustain lower prices. Ulta, though, is likely better for discovering new products. And the more Ulta can make the in-person experience unique, exciting, and personalized, the more they can turn a competitive disadvantage into an advantage. There's a lot of consumer spending research that basically concludes that the longer you hold a product in your hand as you try it out, the more you feel as though you already possess it and must then go purchase it. So there's a secret genius to Ulta making it so that you can try on a ton of products whenever you walk into a store.